Go. All right, folks, this is being recorded. Something I mentioned at the beginning of every single webinar, like a broken record, is watch this video again on the long put calendar. Maybe not specifically the roadmap to trading options webinar on the long put calendar, but one of the other ones would suffice as well. The only reason why I want you to do that is because it will help some of these nuances stick into your long-term memory if you watch it relatively soon afterwards. It really will help you retain this information. If you wait down a couple of months, it's probably gonna be like learning it all over again. All right. So with all that being said, I should say, this is on the long put calendar. This is our roadmap to trading options, folks. What we are, your picture is all that is being shown. Anybody else getting this picture of the long put calendar on here? It says my screen's being shown there. Did that help? At this time, all I'm seeing is you. Everybody else, can anybody else? The picture is all that's, at this time, all I'm seeing is you. Okay, now? Okay, so now you guys are seeing the long put calendar page. Okay, perfect. All right. I don't want you guys to have to look at me the entire time. As a matter of fact, if you want to close that camera of me, then feel free to do that. I'm not going to feel bad. As a matter of fact, I won't even know. Got the screen as it should be. Perfect. All right. Good, guys. Thanks. So with the roadmap to trading options, folks, what we're trying to do here is streamline your process in order to find the right option strategy for any given assumption. I don't like the idea that some people just go out there and talk about, hey, I put this option strategy on around this directional assumption, and they don't give the reasons why. There has to be a reason why you implement a strategy around an assumption. And further, we have some guidelines to follow in order to implement a strategy, like where volatility is. We need to know what the pricing of these options is in order to determine whether or not we're buying an option or selling an option. And that's what I try to take that guesswork out for you guys, and even go as far as to talk about specific locations of those strikes that we should be looking for. Let me get a couple things out of the way real quick, though. My name is Eric Wilkinson. For some of you new faces out there that may or may not recognize me as the Wolfman from mainstream media, where I talk about the economic data, geopolitical environments, how that all comes in to impact the markets. I still do that to this day. We do these daily market commentaries where I talk about that, but I go a little bit further and talk about these option strategies I'm implementing into my portfolio based on my assumptions. So please check those out. Like I said, I started trading. I've been trading for about 25 years. Started trading in college on with some stocks. Moved to Chicago. Started trading on the floor. Since then, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. I'm trading from the screen these days, but still continuing to trade my own money here. All right, so let's get on with it. The long put calendar. All right, this is something I want us to take and put on the shelf for a moment, all right? What we are going, like I said, we don't go into the day saying I need a long put calendar to put on today, and I got to figure out where I can find a market that this will fit. No, we don't do that. We're flipping through the charts or looking at what mainstream media is talking about and coming up with our own assumptions. Then we have to find the right strategy. So let's put this on the shelf for just a moment. We're going to lead ourselves down this path to finding the right option strategy. Yes, spoiler alert, it's going to be on the long put calendar, but the idea is we're going to try and go through this process in order to find it. All right. What we're going to talk about today in this webinar is, once we come up with our directional assumption, that's the first thing that happens on any given day, is we come up with an assumption in something, and it's usually bullish, bearish, or market neutral. It doesn't matter. We can find the right strategy for any of those types of market directions. But once we've come up with our market direction, then we are going to, in this case, we're going to be thinking, okay, well, we're at least market neutral to, long-term bearish, okay? Next thing we need to do is see if XYZ is option tradable, all right? whoops, I went a little fast. Option tradable. That's what we're going to find out. Is that underlying? Is XYZ, Apple? Can we trade options around that? Next thing we're going to do is figure out the environment. What is volatility? Volatility. Something like, I don't know. I'm brain farting right now. The duration. What is the best days to expiration? We're going to be talking about that specifically. And finally, we're going to be talking about strike location. All right. We're going to need to know exactly where our strike location is for these. And we'll talk about all of those things in this webinar. But we need to also understand the roadmap key. And what we're talking about here is when we're looking at the option montage, which is that page with all of the strikes and everything else going on, what do these Greeks mean? Now, don't close out the webinar just yet. We're going to briefly go over this. I'm going to give you guys some really quick, easy ways to remember this stuff. On the floor, we used to say delta is data. It gives you all kinds of stuff like the probabilities of being in the money, probabilities of being out of the money. But what I want you guys to specifically focus on right now is how delta affects the option premium in relation to the underlying. Now, all of these Greeks, before I get too far ahead of myself, all of these Greeks assume a move forward, a move higher. It's an advancement, okay? So with delta, when we're talking about options premium in relation to the underlying, what they're specifically talking about is that first dollar move, $1 move, okay? So when we go over to the option montage, we can easily see that this is XYZ because I'm going to write it in there. I blocked it out because it doesn't really matter what the underlying is right now. I want you guys to focus in on these Greeks. So delta, we can see in this column here, is positive. Delta on the puts is going to be negative. All right, we can see that they're all negative across there because the advancement assumption here, we're talking about a dollar move higher. So XYZ goes to 149.35. So that's $1 move, right? It moved up $1. Well, then our corresponding strike, so the 150 strike here on the calls will increase by 45 cents. So we can see this go to 405, 420 on that first dollar move on the premiums. If we were to move higher, we've got a negative delta over here. So we would see these premiums decrease and we would be looking at them being $2.62 on the bid, right? $2.62 because it decreased by 30 cents as the underlying went up. And this would be $2.72 on that first dollar move higher. That's what would happen to our premiums on just $1 move higher. Now, if we were to look at, and one thing I forgot to say, on a dollar move lower, we think about it as if it moved down $1, a negative plus a positive delta would make this a negative delta to the premium. So those would lose. And if we move down by $1, a negative plus a negative delta is a positive delta. So that would then add into those premiums. Very important to understand that as we are going to be talking specifically about puts, that we need to understand how those deltas are going to be affecting our premiums there. Now, when we talk about gamma, gamma goes with delta. Easiest way to remember, gamma goes with delta. A lot of people are talking about gamma going on right now because of the whole thing with GameStop, and tomorrow's really the gamma day. It's going to really be affecting these guys. So keep your eyes out for some more fun tomorrow. So gamma, if we're talking about this being dollar number one, this is dollar number two, okay? So on the second dollar move, gamma goes with delta. So we would see on this column, we've got gamma on both sides, right? Gamma, gamma on both sides. You'll see that it's positive on both sides. We can see that if we moved higher, now we're trading 150.35, exactly $1 move higher from the previous move. So we've got now $2 move. This gamma goes with delta. So on that first dollar move, we saw 45 cents go into these premiums. Now we're going to see 48 cents go into those premiums. And we would see that this went from $4.05 now to $4.53. So 453 and 468. So on that second dollar move, we would see those premiums increase by the 48 cents. On the flip side, we could see if we moved higher by that second dollar move higher, well, we would only lose 35 cents from these premiums now. So we would look at, it'd be like $2.27 on the bid, and then $2.30. Well, what am I losing? 35 cents here. So $2.37 on the offer. Okay. See how that works that way? And if it was $2 move to the negative side, we've got negative move plus a positive negative delta. That would make that a positive delta then. Okay. So we're going to keep those things in mind as we go forward. But remember, gamma just goes with delta. Delta is the first dollar move. Gamma is the second dollar move. Gamma doesn't really affect the premiums on the first dollar move. Now, theta's our thief. Theta's the thief in the night that comes and steals our premiums. Now, something to know with theta. Theta is more aggressive the closer and closer to expiration we get. Theta is less impactful the further out the curve. Think about it this way. When theta starts getting into the mix, it's closer and closer to expiration because he wants to take all of that premium. They know that there's not much time left to take all that premium, so they get more and more aggressive. Think about it that way. Further out in time, they don't even know you exist. They're not even bothering with you. So theta will be much more aggressive the closer we get to expiration. And something to note with theta, as we talked about, everything is advancement. You can't go back in time. So theta is always a negative in the option montage, okay? The only way that you can really make theta a positive is if you sold the option, right? Because then that theta would come in. If all else remained the same, theta would come in and eat away at that premium the closer and closer, and become more and more aggressive the closer and closer we get to expiration. So you can take advantage of theta. You can't really get rid of it. All right. Does that make sense? So tomorrow we go one day further. So we go wake up tomorrow morning and we would see that theta would come out of all of these premiums if nothing else. I mean, if nothing else changed, the volatility didn't change. The price didn't change a penny. The only thing that changed was one day went by. Okay, trying to isolate that. We would see the exact amount of theta come out of our premiums, okay, one day later. Yeah, John wants to ask a question. Quick question on the put side of delta down. If the price goes up, delta goes down and vice versa on the put side. If the price goes up, the deltas go down, yes, on those strikes because gamma is coming out of it as well, right? So as gamma comes out of this underlying, this is a $5 difference here between the two. If you did 15 cents out of here, subtract 15 cents, right? 5 times the 3 cents of gamma, you can see that is very close with a rounding error to what the price is there, okay? Does that make sense? Between the gaps there, you can kind of see that show up with that gamma. As the underlying goes up, yes, the prices go down. Okay. And as the underlying goes down, those gammas get bigger, as the price goes down, those deltas get bigger because gamma's adding in there, right? Does that make sense for everybody? That's why these are all changing. And yes, I said 15 cents. I know everybody can subtract 15 cents from 38 and you're coming up with 23 and you're going, hey, that's 24. It's off. Yes, it's a rounding error. This decimal goes out. I don't even know how many decimals they probably go out, 5 or plus. And once that rounding happens, either way, you can get that off by what looks like a penny, but it's probably, tenths of a penny or something. Does that make sense? You with me? Cool. All right. Vega is just volatility. So if you see me write vol, I mean volatility. I almost never talk about volume other than when I'm talking about GameStop these days. But volatility, if you hear me say vol, I mean volatility. That's Vega. Easiest way to remember the non-Greek. Well, it's considered a Greek in options trading. It's not in the Greek alphabet. But Vega is volatility. And it affects the premium for every 1 percentage point move in that underlying. And it seems like I I'm going to have to use this. Oops. Here we go. We'll use this. All right. So Vega is right here. All Vega is implied volatility. All right. It's implied volatility. So I'm going to come back with that. I'll be referring it back and forth. But implied volatility. Volatility is always a positive, as you can see in this line here. We can see volatility, or Vega, is always a positive. And that's because the assumption is a move higher. That will happen. What will happen to our premiums? If we moved 1 percentage point exactly higher, exactly 1 percentage point higher, that's up 1, right? Up 1%. Then we would see these premiums increase by the corresponding Vega. All right. So we would see them increase. And you will note that as implied volatility increases, all of the premiums increase, whether it's puts or calls. I've been talking about this in the daily market commentaries for the last week, probably, talking about these puts in GameStop. We saw GameStop rally $200. Okay. It rallied $200 and the puts increased in value. That's counterintuitive to what we would normally think. Why? Because the deltas weren't enough. $200 was basically $2 in those way out of the money puts I was talking about. The increase should have decreased. The increase in the underlying should have decreased the value of my puts by $2, but the volatility exploded, and that volatility completely offset the directional move on those puts. So we were watching for the last couple of days GameStop go through the roof, and the puts increased in value. And that was all due to the fact that volatility was blowing out. Okay. So we can see that happen. That's why it's important to understand where volatility is in relation to this underlying. All right. That is one of the major things that we're going to be looking at when trading options, because we want to try to avoid volatility blowing up on us. We can't always have that happen. In this case, it even happened to a guy who traded for 25 years. I've seen it happen before, probably never to this type of extent that we're seeing in that underlying, but it does happen. All right. So we're trying to avoid the pitfalls of getting involved in a trade that is not set up in our favor. And that's one of the keys, is if you're selling premiums, you want to have volatility be pretty high. When you're buying premiums, you want it to be relatively low so that you can get the expansion in volatility. Will help you. Does that make sense? Perfect. All right. So yes, we are talking about the long put calendar. Where are we going? First thing we do is we find an underlying. We decide what type of trade we're going to put on around this underlying, right? It doesn't always even have to be anything major. Like, what I do is I will look at the charts. Here, I'll pull up my platform and give you a brief example. If I can get it out from underneath here. So what I'll do is I'll go to the charts and I will just literally start doing this. I don't even see what the underlying is that I'm clicking on. I'm just looking at chart setups and stuff like that. Like that, I would say is a confirmed top in eBay. I would be trying to play that to the downside. I'm not coming into this saying I want to do a long put calendar on it and I got to find the right one that'll fit for it. No, I'm looking at, coming up with an assumption, and how I do that is I click through the charts and try and find some, read the tea leaves, right? Well, in this case, let's just say I was flipping through and Facebook just had their earnings today. Let me move this out of the way so you guys can actually see Facebook. Nothing. You guys, things don't want to work for me easy today. All right. So I'm looking at Facebook. I obviously took this before the close, but I am looking for Facebook to it's rolled over a little bit, trade a little bit sideways, and then, long-term heading into, the next couple of months, I think that we're going to see some weakness here in Facebook. However you come up with it. I'm not trying to give you guys a trade example right now. I'm just coming up with a great example of, when we come up with an assumption, how we would put a trade on around that, right? So I basically have a somewhat market neutral assumption, but believe the long-term trend is going to be bearish for Facebook. I think that they're going to see some of their marketing pull back a little bit. I think less and less people are going to be using Facebook. Let's just say that's how I came up with my assumption, okay? All right, so I'm not bullish, but I am more neutral to bearish long-term bearish, all right? Long-term bearish, maybe short-term. I think it's going to settle down, short-term thesis, whatever you want to call it, all right? So starting to get the gist of what I want to do here. I went short-term neutral, long-term bearish, but I think it's going to settle down right here. Well, that starts leading us down the path of finding the right strategy, right? So in the sense, I think, we're going to be short-term kind of trading sideways and then kind of sell off towards the end there. And therefore, it's starting to lead me to finding the right strategy. Or do we have a good destination? I'm looking at Facebook. I need to know whether Facebook is tradable. Meaning, when I pull up this thing, it's really because wherever our final destination is, or whatever the underlying is that we're looking at, is there a lot of things going on? We don't want to end up in the middle of nowhere where there's nothing to do. If you had goods and services, or if you had your kids in the car, and you wanted to go to a destination and you showed up and all that was there was a blinking yellow light, well, your family's probably not going to be very happy with that vacation. But if you went somewhere where there was all kinds of things going on in Orlando, then they might be a little bit more happy with you. Well, the same thing is with Facebook. I switched off that Facebook chart. I'll get you a Facebook chart here in a second. Is anybody seeing this current page of Facebook's option montage? And I took this screenshot when Facebook was obviously in positive territory. So let's just go with this example real quick because it's easy to write on the page. All right, so do we have a good destination? Basically, what I'm talking about here is there a lot of market participation going on? A lot of eyeballs in here, a lot of open interest happening, good destination to determine that. What we do here is we take the underlying, we move the decimal if it's greater than $100 stocks. If we have stocks that are less than $100, I have a rule for that. If it's greater than $100 stock, then we're going to do this little trick where we move the decimal 3 ticks to the left, and basically that gives me 27 cents, right? Well, I'm going to take that information and look down here at the option montage and look at these options that are just at the money or out of the money here and come up with, does it fit that rule? And if we're following along with my analogy of, is it a good underlying to trade? Is it option tradable, or all of those things? What I want you to think about is, with this analogy, is we have a stoplight following along with, the roadmap theory or thinking. And if it fits my rule, then we're looking at it as being a green light. So, this fits that rule, 25 cents. We got 25 cents, 20 cents there. All right, 25 cents. So we're pretty good to go on those, right? So that's saying we're pretty good rule on that. If it's 2 times the rule, then we're calling it a yellow light. And 3 times the rule, just run away. It just means there's nobody in there. It's too volatile, could be, all right? All of those things, when those bid offers get too wide, especially for newer traders, that's the time to really pay attention, because you could have a lot of volume and open interest. If those bid offers are really wide, you could be giving up too much edge to get in, too much edge to get out. So if you're a newer trader, try and stick with this rule. And like I said, if it is less than $100 stock, so that's if it's greater than $100 stock, so greater than $100 stock, that's what we're looking at, right? With this one. And then if it's less than $100 stock, then I say it needs to be less than or equal to 10 cents wide, right? And still following along with the rules. Fits that rule, less than $100 stock, green light, 2 times the rule, 20 cents wide, and it's less than $100 stock. Put the caution light on. So 30 cents wide, just walk away, okay? It's not good for like the newer trader to get involved in that kind of stuff. It's just way too wide. All right, so I actually had this up because I was going to drill down on that a little bit more, but basically the same idea. Move the decimal 3 ticks to the left, 27 cents. Check it out. Make sure it fits that rule. In the options that are closest, the ones that are close to 35, closest to 35 days to expiration, all right? That's the spot month, all right? So it could be like 40 days where you're looking at this, whatever is closest to 35 days to expiration, that's where we're looking for this rule. Now, keep in mind, we are doing a calendar where we're looking at an option contract that might be 70 odd days out, okay? Well, that being the case, 70 odd days out, we're not looking for this rule in that month that we're trading. We're looking at that rule in the spot month. We might be trading an option that has longer days to expiration, but we want to look for this rule in the ones that's closest to 35 days to expiration, because the assumption is everybody's trading that now. They're going to eventually be rolling out there and tightening those markets. Further on that idea is that there are tighter markets out there, especially in something like Facebook. There are markets out there that are not really being shown. They're kind of in the weeds, really, is what we used to call it on the floor. You don't really see them all the time, whether it's a spread or things like that, that you're not necessarily seeing. Those markets could be much tighter. So as long as there's a lot of volume and open interest going on in the spot month, that is what we are most concerned about, okay? All right, the next thing we do, we've already figured out our directional assumption with Facebook. We've already figured out we can trade options around Facebook. Next thing we need to do is, what is the environment in and around Facebook? Now, what I mean by this, remember, this is volatility. What is vol doing in Facebook right now? And we have to determine if it has low volatility, then we kind of look at it as sunny skies, you know. But ultimately, low volatility is going to tell you that the options are really cheap. And when volatility is really high, what it's telling you is these options are really expensive. So the idea is you buy low and sell high, right? Well, what we were going to do is go over to Facebook again and figure out where implied volatility, which is just that vol, Vega, all right, is in relation to where it's been in the past. Because what we notice is, yes, we do have this crazy spike out here. We also have this really low type environment down here. Well, I discount those because this was back in 2019. This was at the height of the pandemic. The height of the pandemic, in my eyes, was a black swan event, all right? Are we going to see that? Well, the last time we saw a black swan event like this type of volatility across the board was in 1987. Before that, it was like 1929. So not even during the height of the financial crisis did we see this kind of volatility. That's why I'm saying that needs to be taken out of the data set. Kind of like divers. You take out the extreme low and the extreme high, and then they average those middle ones in a sense. Kind of. But what I want to do is look at what's going on now. And ultimately what I want to see, every underlying has its volatility coefficient, and it will generally stay within those range-bound areas, you know, barring some kind of crazy black swan event. So what we can discern from this is that when they are at these peaks, those premiums are expensive. And when they're at these troughs, these premiums are cheap, right? So you want to sell on the spikes and buy on the troughs. Well, we've also got volatility coming out here. We got to keep that in mind as well for this strategy, volatility coming out because they just had that earnings. So we're going to keep that in mind as well. But what I can tell that right now, you know, if I said that middle of the road is kind of like your, you know, below watermark, you know, you can see it's actually below that middle of the road, the median in a sense. So the idea is basically below the median, you're seeing cheaper premiums, and above the median, those are basically elevated premiums, okay? You know, obviously the extreme lows and the extreme highs, those are pretty easy to figure out there. But what I want to come from this is I can see that this basic 0.42 here is below that middle of the road. So I'm leaning towards they are pretty cheap premiums in Facebook at this point. All right, so I'm going to say that they're relatively low. And why does volatility matter? Because as volatility expands, remember we showed that as 1 percentage point increases, those premiums across the board, all other things being equal, will increase. I talked about that with the GameStop example as well. And when that volatility comes out, those premiums decrease. So we can sell high, buy low, and when the premiums are cheap, we buy low and sell high. We can be directionally wrong and make money when we set it up correctly, okay? You know, if I sold puts with really high volatility and the market went down, but that volatility came out, well, then I could be directionally wrong and still make money. Kind of similar to the flip side of my GameStop. I sold puts, the market went higher, but volatility expanded. So I was directionally right, but I did get the volatility wrong. I'm not going to lie. No, I didn't expect volatility to explode another 100 percentage points, but it is what it is. All we can do is try and set ourselves up for success there. And I believe I did just that. All right. So despite the fact that I may have gotten that wrong. Now, let's drill down on one other thing I did want to say is, you know, when volatility, I said it once, but I want to show you guys, when volatility is high, we sell premiums. When volatility is low, we want to be looking to buy premiums, generally speaking there. So back to this example, when we're looking at the high-low, you can find this on the option montage page as well, at least on TD Ameritrade. You can ballpark it like I said, you know, okay, yeah, it's below the medium, the high water mark or whatever you want to call it, the median. So I'm saying they're relatively cheap. But if you really want to drill down, and if you find it on the platform, it's going to say about 29%. I'll show you where to find that in a minute. But if you are really wanting to dig into the details here, all right, the hack is to kind of draw your imaginary lines in there, figure out where the middle of those two lines is, and then you can easily pick, you know, that would have been high. This is going to be lower premiums, right? But if you want to dig into that detail and know the exact number and want to discount this because the platform will include these, okay? The platform will include those. So if you want to not include those, take the current implied volatility minus the low volatility, implied volatility, and take that sum and divide it by the low IV, or high, the high IV, high IV minus the low IV. I don't want you to get a negative number here. So basically what we want to figure out is where the current is in relation to the high and the low, right? So right now we've got current implied volatility is 42 here in this example minus the low implied volatility mark right there, which we're going to call, I'll call it 34. All right. The high is just coming in. We're going to call it 59, 34. So 59 minus 34. All right. So I've got 8 divided by 25. And that's going to give you right around 32-ish. All right. So 32 implied volatility percent. So when we're figuring out this implied volatility percent, if it is less than 50%, you're looking to buy. If it is greater than 50%, you want to sell. All right. Now, if you have a lower risk tolerance, like low risk, I have no problem with you saying like, okay, if it's less than 30%, I buy. And if it's greater than 70, I sell. Okay, it's going to limit your opportunities, but it will get you to a point where you are literally buying some of the cheapest you can get and selling some of the most expensive you can get. All right. And once it goes to 100, you would say that, okay, those are the most expensive I've seen. Well, it can still go higher, and that's 100%. That's a flaw in this this mathematical equation. It goes lower than the low, then that's still zero. Okay, it's going to be part of that. But we can see like this would have been, lower in a sense. Like if we got that move, yes, it would still be zero here, and it's still zero here. And if it keeps going down, it's still zero there. All right. So, but what we do see is it has a tendency to want to stay within a certain range for that given time frame. And I would not expect the volatility to really change for the next foreseeable future here. Maybe a couple of years down the road, that's a different story. I don't look that far down the road. All right. I'm only looking 6 months out, maybe a year in some regards. So in that case, I'm going to go with this being our new normal for something like Facebook. Okay. Now, what's the duration? Well, like I said, we need to understand how the premiums are going to affect us. If we have low implied volatility, then we want longer duration because we want to limit that thing. If we have low volatility, right, we're thinking we need to buy an option. And if we've got to buy an option, I want to limit theta decay. How do I say you limit theta decay? You got to go out further on the time horizon, right? Because theta isn't as aggressive. So if you're ever buying options, even if you're only planning on a short duration move, maybe the next couple of weeks, you still want to use those longer duration options because you're going to save yourself money on the erosion of those premiums. Yeah, you do have to pay a little bit more for those, okay? But you're losing less money, okay? So, and you're allowing yourself more time to be right. So when you're buying an option, trader wants to limit theta decay, and when you're selling an option, a trader wants to exploit theta decay. Well, spoiler alert, we're doing both in this one. But what we're going to be trying to do is buy out here. We're going to be buying our put out here, and we're going to be selling a put inside of this area. So we can see what happens in the puts that we're selling. This is theta. This is representing what happens to our premiums according to theta. And we can see theta gets really aggressive inside of 7 days. Remember I said, those options that are expiring tomorrow, everybody's talking about the gamma that's going to happen with GameStop. Well, yeah, that's a play. I like to stay out of this area. That's exactly why I don't like big money likes to push stocks in their directions, and they usually have more money than the rest of us, so they get their settlements. But before then, they don't mess around with it. So the free market price discovery works in our favor, and theta will eat away the premiums that were short, and we will retain the premiums that were long. Okay, which is exactly what we're trying to do with this type of setup. Take advantage of it. So we've got two durations. We want to sell the one that's closest to 35 days to expiration, and we want to limit our theta out here on the time horizon, okay? And I'm basically saying, you want to get outside of basically 70-ish days to expiration is really where I kind of like to talk about that. All right, trying to buy. So we kind of got that figured out there. All right, so what vehicle are we using? Well, we've got the short-term market neutral, long-term bearish. Well, in that case, I can take advantage of it with the long put calendar. I've got all of the things working in my favor for this strategy. My assumption, the underlying is good. I've got my directional assumption. I've got the environment figured out. I know how I need to take advantage of this. I need to do the long put calendar. And how do I set this strategy up? Well, I like to go for, a lot of people online will say the at the monies, okay? I don't like to use the at the monies. I like to give myself a little bit of wiggle room. Now, the more bearish you are in the immediate near future, the further out of the money you're going to be looking for on the short the short put, okay? So I really like to use, if I'm more bearish near term, I'm going to be looking at the 36 delta, or if I'm worried about the any downside move. Now, if you want to get more aggressive, maybe even think there's a little bit of sideways, maybe even slightly higher, then closer to the at the monies is fine. I usually don't use the 50 delta, but I will go to like a 45 delta on this near expiration. That's the first step in figuring out our strike locations. We don't really have to do a whole lot of legwork to figure out the long one, because when you're doing a long put calendar, you're using the same strikes. Now, we'll talk about what happens when we're using different strikes next week when we're talking about the diagonals. But right now, I want you to think about all you need to do is figure out this first strike location. This is your real risk in the trade that you're really going to be concerned about, is that short one. So I like to use the 36 delta. If you're more market neutral in the near or in the immediate term, then you can go to the 45 delta. I just like that 36 delta myself. That's my sweet spot for this one. Is the 36 delta equivalent to a half a standard deviation? 1/2 of a standard deviation move. 16 delta is 1 full standard deviation. All right, so what spots do we pick? Now, of course, if you guys watch the daily market commentaries, you guys know that I did a Facebook trade and earnings. So, of course, it showed up in my Analyze tab today with the, positions thing. But here's what I'm looking at. I sold before the close. Everything's changed now. So I'm going to use this. But this is the Analyze tab. Let's just pull up the platform, because everything's different now. I noticed it towards the end of the day. Let's just use this. Let's go to Facebook, because I'm flipping through the charts and all of a sudden I come across Facebook. You can see it's gone down to my short strike already. All right, so if I were to build this up right now, I'd be looking for that 36 delta. Yes, you could do the 45 delta or ish. I don't like to use the half ticks, plus there's not going to be any half ticks way out in time. But with that being said, so I would fall maybe a little further away. I'd sell the 255s. So I know I've got to buy the 255s out here and come up with my strategy. Now, one thing I forgot to mention last week going into this week, and I'm remembering again now, volatility. This is really important where volatility is. Remember, I was talking about taking advantage of volatility mostly when we're talking about this. Well, because we have two separate expiration cycles with volatility in this, we generally see, like I said, theta is more aggressive the closer to expiration, limited further out. Well, volatility usually affects further duration options more than the nearer duration options. Well, we've got a bit of a difference here in Facebook, where we can see that Vega in Facebook is 44. Vega in Facebook out here in this option contract that I'm looking at here is 41 or 42, you could say on the rounding. Vega usually increases going out the time horizon here, so it's decreased. That means the options, because I'm looking to sell a put, right? I'm selling a put and I'm buying a put. That means the ones I'm selling have more volatility in them than the ones I'm buying. That's a good thing. Generally, we see this increase. And now last week, if you guys watched the one on the call calendar, it was a little bit different. I was saying, hey, folks, sometimes you will see it where volatility is higher in the one you're selling than the one you are buying. And that is a no-brainer, okay? But usually volatility increases out the time horizon, all right? And when volatility affects further duration options more, what we see is this number is a little bit higher. So following along that idea of we've got stoplights, right? If it is less than 3 percentage points increasing, then it's a green light, right? If it is basically 3 to 5 percentage points All right, we're talking about a yellow light, and if it increases greater than 5%, then it's sorry. This is less than, Eric. Less than 3%. It's a green light. If it is greater than 5%, it's a yellow or a red light. Okay. So in that case, I'm normally talking about increasing, less than an increase, that's a negative 3% or negative 2% increase, right? If you want to do lawyer speak, it is not a positive increase. So in this case, it is definitely a green light because the one I'm selling is chocked full of premium versus the one that I'm buying. That is a no-brainer first case scenario. Any reasoning behind the use of the 36 delta? Yeah, it is right close to a half a standard deviation move. So it gets me out, meaning I've got a pretty good probability of this being out of money at expiration, okay? That's the reason why I like to use that. I want a high probability of my short strike being out of the money at expiration. Okay? If it is right there at my short strike at expiration, then that's where I'm going to make the most money though, okay? If these puts expire worthless over here, if these puts expire worthless, then basically, and the underlying has moved down to 255, I have made the most money I can at expiration. Now, after expiration, everything changes. The underlying can go all the way to 0 and I'm fine. But during the life of this option, what we'll see happen is go over to the Analyze tab. Again, it's still going to probably show Analyze the Trade. I've got that old one in there, so let's get rid of that. You can see that we've got the Analyze tab. Right now, the underlying's trading right here at this line. If it moves down to just 1 penny higher than that 255 strike, that's the most money I can make. And the idea here is to make it where you're risking one about to make one. All right, this one's slightly skewed where I'm risking a little bit more to make one, and that's because I've slid it down a little bit further. So we can see that there is limited risk on this. This will flatline at the further we go out in time. But ultimately, the most money to be made during the life of my short option contract, during the life of the next 25 days of this February or 22 days of this February, if it goes down there to 255, then I will make the most money I can. Now, after expiration, if this 255 short put expires worthless, then the underlying can go all the way to 0 and you can make money. All right. But during the problem with this is it's hard to determine your break even, all of those things, because volatility expanding and contracting at different rates in the different months will make that more difficult to discern what your break evens are. Now, I've got a couple of option hacks or a couple of hacks for this that we used to use on the floor. They're not beautiful hacks. I'm not going to say they are much less aggressive than the break evens that you will normally see. Meaning I'm bringing in the break evens tighter than what you will normally see your break evens, just to, keep your powder dry and stuff like that. It won't never look as bad as what is showing on here. Because here you can see the break even to the upside is basically right around 270 or 277 to the upside. To the downside, it's 236-ish. All right. Now, my rule for this is just basically you take the debit you paid, add it to the strike, that's your break even to the upside, subtract it from the strike, that's your break even to the downside. That's kind of it for a ballpark. That's really the best way for me. And then holding solace and knowing that my break evens that I've come up with are much tighter than the break evens that I'm actually able to get with this type of trade. Okay. So you guys got this. We'll go over this another time. I'm going to do other examples, but for some of you guys that probably need to go, keep it inside of an hour. we've got our directional assumption, right? We're market neutral to long-term bearish. Our destination, this is XYZ is, fitting my rule, fits the rule. All right, fits the rule of moving that decimal, right? Less than $100 stock, less than or equal to 10 cents wide to the bid offer. All right, if it's greater than $100 stock, then we need to make sure that these are less than or equal to the 3 decimal move. Okay, I see your question popping up. Give me a second here. Environment, this is volatility, right? Implied volatility, to be specific, and where that is. That was my thing, where if it's greater than 50%, you're going to be looking to sell premium. And if it's less than 50%, then you're looking to buy premium. Duration, we've talked about this. We want, the buy to be long days to expiration, long-term days to expiration, like 70 plus. And when we're selling a premium, we want less than, or we want it to be right around 35 days to expiration. All right. Strikes, we've got this. We're looking at the 36 delta short put. All right. And then we know we got the same strike in the further duration one. 36 delta, won't that mean that the probability is 36% of being in the money? Yes, but I mean, that's a 64% probability of being out of the money, right? Yes, there's a 36 delta, meaning there's a 36% probability of being in the money, but it's also a 64% probability of being out of the money, meaning I have a better probability of being out of the money with my short strike. Now, keep in mind, I've got that long put that's making money on the downside, right? So, we're going to kind of see this market with a theta decay eroding at my short strike market direction. We're going to see that long put gain in value faster than our short put, or gain in value faster than our short put's going to gain in value on a down move because of theta and volatility and all of those things. So, all right. So our max profit, we know that our max profit at expiration is going to be when that underlying is trading at the strike price. Now, we don't know exactly what that max profit is. Why? Because we could see this short put expire worthless, and volatility in that long duration option is expanding. So our max profit still is kind of a guessing game in a sense, okay? Because of that long put gaining volatility. It could also lose volatility as well. So we don't know our exact max profit on this. The real thing that I'm trying to do is lower the cost basis of my long puts, right? You guys know I hate buying, for at least the people that have watched the daily market commentaries or some of my other webinars, know I hate buying options. If there's a way to lower my cost basis on things that I'm buying, I'm going to do that. And this is a perfect example of that with this type of strategy. If I have long-term bearish assumption in a low volatility underlying, well, then this is a great option strategy, that especially with the volatility higher in the month I'm selling than the one I'm buying, which is a rare occasion. I want to take advantage of that type of skew happening in that market. We do know our max loss. You can't lose any more than what you pay. That is the beauty in this. We know exactly our risk, at least. We don't always know our rewards or where our break even is. And here is that floor trader hack that we used to do, is on a call diagonal or put condor, a diagonal or a calendar. We ballpark our premiums, and in this case we're talking about the calendar, but we ballpark our premiums and take that short strike. In this case we are looking at the 255 puts, right? And we had an $8.30, let's just call it 38 cents. I can't remember right offhand exactly what it was. So our break even to the upside would then be looking at 263, right? And to the downside, subtracting that out, we'd be looking at 248 or 247, I mean, 247. And that is well inside what the break even is going to be on this right here. As we can see, this break even is lining up with 280 something there on this example when I screenshotted it. And, you know, if I just did the add $8 to this, that would have been about 273. So I'm saying the break even's here, and I'd be saying that the break even is probably here. So you can see that the break even is much better than where I'm suggesting. Okay. All right, cool. So we got the expiration, all of that stuff. Now what we're looking at is we're looking at the long put calendar. All right, I'll write it in. Long put calendar. All right. And I've got my strikes, right? I'm looking at that 255. What was it? The Feb April, I think I was looking at Feb April 255s. Buying the April, selling the Feb 55 puts. Sorry, I'm all over the place with writing. I'm trying to get too ahead of myself. All right, so with that being said, on a winner, all right, I'm looking for somewhere between a 30 and a 50% increase, all right, in my premium, 30 to 50% increase. Now, write it down. Am I looking for a 30 or a 50% increase? Put that down because that will help you stay mechanical, all right? So if my premiums on this debit paid, I'm paying an $8 debit, increases by 30%. I am looking to get out of this when it's trading somewhere around, what is that, 30% increase on $8? That's going to be somewhere around $2.50 or something. So $10.50, let's call it, something like that. I would just do the increase of 30%, figure that out. On a loss, I'm probably going to take my max loss on this, folks. Anytime I do a trade where I'm doing it for a debit, I like to just let the probabilities play out. But you could say, all right, a 50% decrease in the debit, then I'm out. All right. So write those things down so you will stay mechanical. When this happens, you will get out where you wrote it down. If you have it stuck up here in your brain's going to play tricks on you and try and get you to squeeze this stuff out a little bit longer. And that's where you get in trouble. All right. That's where things will start going bad. So please avoid that at all costs. All right. So let's just go through an example again real quick on this. So we're looking at that Facebook trade. For instance, on this, the debit paid is $8.38. So what I would do is say $8.38 times 1.3, that's an increase of 30%, would equal $10.89. So I would probably write down, all right, I'm getting out when this thing trades $11. I'm not looking to try and get this max profit. Why? Because the only way to have that happen is if the underlying on the last day of trading the February option, it was just 1 penny out of the money. So these Februaries would expire for zero, and I would get the full move of the long puts going all the way down, all right, from the current location being 65 all the way down to 55. So I would make that difference, all right. Now, the other problem is if I wait too long and my short puts go in the money, I have to deal with assignment risks and all that stuff. Yes, I do have the long option to offset that. So I don't have to worry about my being naked a put or anything. I have something that has defined that risk. I can go and offset that with somebody else. It's just too much commission cost, too much of a headache, all right? I get down to this 255 strike, I can almost assure you that you're going to have seen your premiums increase by at least that 30%, okay? And that's what we're looking for. So just to run through this again, one of the things we're looking at Facebook at the charts, come up with that market neutral, the long-term bearish move. I come into the options. Move my decimal 3 ticks left, 26 cents during open market operations. You can see after the close. That's why I took a screenshot during open market operations, because all the markets get really wide. So you have to do this rule on, is it fitting, open interest and all of that stuff has a good destination during open market operations. All right. So make sure you check that then, and not while you're doing, maybe a lot of you do your homework after the close or before the open. Well, you need to make sure that the options are tradable during full swing of open market operations. But say, for instance, I figured that out. All right, now I got to look at, do I have a good environment? One of the things with the environment is low volatility for itself, right? I can see I've got low volatility in relation to where it's been in the past. That leads me to believe that there is cheap premiums, all right? Next thing I want to do with volatility is make sure that Vega does not increase more than 3% to the one that I want to buy. Why? If it is increasing, that means that I'm paying more out here than the ones I'm being able to sell it for. I don't want a major discrepancy between these two. I don't want a 5% increase. I would not want to be trading a calendar if this was saying 50, because that would be well outside of my red light range, right? Remember my analogy? If it's less than a 3% increase, which would, if it's less than 47 in that case, then it is a green light. We can see this decrease. That's telling me these premiums in this option are expensive in relation to what we're seeing in this. So it's a great time to sell premium here and buy premium here, okay? Yes, one could say, yeah, well, premium's probably still maybe even a little expensive out there. Well, I'm not here to argue that. What I'm saying is, I know that if I sell this premium, I'm selling expensive and buying relatively cheap, okay? So that's what I'm looking for. And then the one that I'm selling is paying off a lot of the premium of the one that I have to buy, even more so, all right? And then you can go over and look at the Analyze tab and all of those things. But that is what's making this fit the rule. Now, let me try and find something really quick without having, done any research on volatility. That one's increasing. Who else has had? Let's just see. I'm just going to throw somebody up there like Goldman Sachs, because I know the banks. Right now, we've got earnings season going on. So a lot of the volatility in these front months are going to have more premiums pumped into them, okay? So, but we can see that this one still decreases a little bit. Let's look at SPY just to find an example where volatility is probably increasing. And you can see volatility does increase. But I could still do a calendar around this because it's increasing less than 3 percentage points, okay? But usually this is the normal where we see volatility increases out the curve as opposed to decreases. Facebook, we've got a perfect scenario where we can sell high premium, buy cheap premium. That's what I'm looking to take advantage of for this. And finally, we've got our durations figured out, right? The one we're selling wants to be inside that wheelhouse of that massive theta decay and take advantage of limited theta decay out there 70 some odd days out. Okay, on the duration and our strike locations. I personally like to use something around that 36-ish delta to sell and then buy around that same strike, okay? Yes, you can be more aggressive. I have no problem. If you thought the market was going to rally for the next couple of days but really sell off, then, you could get a little more aggressive and get closer to the at the monies in that case. All right, does anybody else have any other questions there? All right, well, I'll tell you something else. This strategy works great around earnings. Now, I didn't do this example around an earnings, but I have done webinars on using this specifically for investing going into an earnings. And you can check out all of those rules with this specific offer that we're giving you guys today. It is the earnings with options. You get full access to the entire catalogs of my earnings trades, you guys, and I specifically set them up differently. We talk about, as a matter of fact, when the timing is, you should be implementing a trade around earnings, okay? And you're going to be able to spot the strategies quicker for these big moves, understanding the probabilities being in your favor, all of those things in this course for 36 bucks. If you're listening to guys on TV talking about options trades around earnings, it's going to cost you more than that $36. Because remember, that would be 36 cents in option speak, because, you know, with the option contract multiplier, 36-cent option is actually $36. So if you get involved in losing 36 cents in options, I can probably save you that angst if you take advantage of this course, and you will find out all my rules for that there. I'm going to throw that in the chat window right now. Let me drop down my chat window. Like that. There we go. Sending that out to you guys. There should be a hot link there for this offer. Make sure you guys take advantage of that. Here is the link if you guys are watching it on tape delay. If you're watching it on live stream, make sure you take advantage of that. Again, here is the link if you're watching on tape delay. I want to thank you guys all. Later webinars will drill down on different option components, when and where I find those. If you guys have any questions, comments, or anything of that nature, make sure you reach out to us, or you can email us at trading@protraderstrategies.com. Make sure you guys take advantage of this. Like I said, it's over there in the chat window for the hot link. Otherwise, if you're watching on tape delay, you're going to have to pause and punch this in your URL. All right, finally, take a look at the disclaimer here, folks. We are an option educational company. We know that there are risks involved in trades. We have seen that. There are risks. Know your risks, know your reward, know what you're getting yourself into. And if you can't take that, take it easy. Bye for now. Well, I'll say bye for now, as long as nobody else has any questions, right? No questions out there? All right, Dan, appreciate it. Thanks. Take care, folks.